Hi guys, this is the third lecture in chapter 5. Lecture number 3 in chapter 5. And we are finalized learning objective number 5. And if you remember, we calculate the break-even point in units and in dollar amounts or sales amounts. The last thing that we finalize, how to calculate the break-even point in units and in sales amounts. Now, I will start with learning objective number 5. Determine the level of sales needed to achieve a desired target profit. Determine the level of sales needed to achieve a desired target profit. Now, we are not talking about a break-even. If you remember, the break-even word means that we need to get the zero profit. The break-even points, either we are talking about units or in dollar sign sales, we are talking about zero profit for the break-even. Now, I need to achieve that target profit. So what is the amount that I need to sell in the sales dollar in order to achieve that amount of target profit? If we calculate it in units, which means I have to sell that much or many of units in order to get that target profit. Then our learning objective number 6, determine the level of sales or units needed to achieve a desired target profit. So the topic is the target profit analysis. In target profit analysis, we estimate what sales volume is needed to achieve a specific target profit. We can compute the number of units that must be sold to attain a target profit using either the equation method or model or the formula model or method. Now I'm talking about two things: to calculate the units needed to achieve that target profit or the sales volume needed to achieve that target profit. Just to remind you, what is the equation and the formula? Equation, we say the profit is equals to sales minus total variable cost minus total fixed cost. And to remind you that the sales minus total variable cost is equal to total contribution margin. So the equation can be total contribution margin minus total fixed cost. And how to calculate the total contribution margin is simply the contribution margin percentage multiplied by the sales to calculate the total contribution margin. All minus total fixed cost will equals to the profit. This will be the equation method. The formula, if you remember, we use the contribution margin formula. For the break-even, we use the fixed cost divided by the contribution margin. For the break-even point in units, we say fixed costs divided by the contribution margin per unit. If we need it in a dollar sign, then we use the Let's start in calculating according to the equation method. According to the equation method. Okay. For the equation method, as I say, the profit is equal to unit contribution margin multiplied by quantity, all minus the fixed expenses. The contribution margin per unit multiplied by quantity, this will give you the total contribution margin, minus the fixed expenses, this will give me the fixed expenses. The total contribution margin minus the fixed expenses, this will give me the profits. Our goal here is to solve for the unknown Q, which is the quantity. Again, the question, how many units do we need to sell in order to get that much of profit? So, which represents the quantity of the units that must be sold to attain a target profit. Now, I need, according to the example, suppose that RBC's management wants to know how many bikes units must be sold to earn a target profit of 100,000. Our target is to achieve 100,000 as a profit. So I will say the profit is equal to unit contribution margin or contribution margin per 1 unit times the quantity minus the total fixed costs. We need 100,000 as profit dollars equals the contribution margin per 1 unit is 200 from our example, or the same example that we start with the chapter. And the unit contribution margin is calculated from price minus variable cost, which is 500 minus 300. This equals to 200 minus or multiply by Q, which is the needed amount or units, all minus the fixed costs, which is given in the question for 80,000. Then the Q can be calculated from 180,000 divided by the $200. $180,000 divided by $200, and the answer will be 900 units. 900 units. The meaning of the 900 units. The meaning that we need to sell 900 units in order to get $100,000 as a profit. So we are exceeding the break-even. Again, just to remind you, the break-even means profit is zero. Now, if I need to attain the $100,000 as a profit, then we are exceeding the break-even point. We need to sell 900 units in order to get $100,000 as a profit. If we use the formula method, that was the equation method. If we use the formula method, then the unit sales to attain the target profit is equal to the target profit plus the total fixed costs, all divided by the CM ratio per unit, or the contribution margin per unit, the contribution margin per unit. Okay. Remember that we are calculating the unit sales or sales and units here. So we are not using the ratio, we are using the contribution margin per unit. Again, if I need to calculate how many units do we need to attain that much of profit, then we are modifying the contribution margin formula by the following. The target profit will be added to the fixed costs and all divided by the contribution margin per unit. So the answer will be per units. If we use the contribution margin ratio, then the answer will be the sales amount in dollar. okay, in dollars. So the unit sales, how many units do we need to sell to attain the target profit of 100,000 is equal to what? 100,000, which is the targeted profit, plus 80,000, which is the total fixed costs, all divided by 200. So again, $180,000 divided by $200, this equals to 900 units. So we need again to sell 900 units in order to earn or to get the $100,000 as a target profit. The answer here is represented by units, not dollars. If we want to calculate it according to the dollar sign, then we need the ratio, the CM ratio, which is the next slide. Now, the target profit analysis is the formula method for the sales dollars. We can also compute the target profit in terms of sales dollars using either the equation method or the formula method. If we use the equation method, then we will say the profit is equal to what? The contribution margin ratio multiplied by the sales, and this will give you the contribution margin total in dollar sign, all minus the fixed costs. For our target, we need to get $100,000 as a profit. The contribution margin ratio, if you remember from our example, it will be calculated as 200, which is the contribution margin, divided by the price, which is $500, and this equals to 0.4 or 40%. Multiplied by the sales minus the 80,000. So the missing amount here is the sales in a dollar sign. The 40% sales is equal to 100,000 plus the 80,000. And the sales is equal to 180,000 divided by the 40%, and this will give sales amount of $450,000. So we need to sell that much in order to get $100,000 as a profit. Okay. We need to sell for $50,000 in order to get a profit of $100,000. Using the formula method, the sales dollars or the dollar sales to attain the target profit, we will use the same formula, the target profit plus the fixed expenses, but we will divide it or the total for the contribution margin ratio in this case. Remember that if we divide by the contribution margin, the answer will be in units. If we divide it or the total for the ratio, then the answer will be the dollar sign for the sales. So the dollar sales are equal to target profit is 100,000 plus the fixed expenses are 80,000. The contribution margin ratio is 40%. Then the answer will be $450,000, the total amount of the sales in order to get that target profit, which is $100,000. A quiz. Coffee Clutch, if you remember this quiz, is an espresso stand in a downtown office building. The average selling price of a cup of coffee is $1.49, and the average variable expenses per cup is $0.36 or $36. The average fixed expenses per month is $1,300. Use the formula method to determine how many cups of coffee would have to be sold to attain a target profit of $2,500 per month. Now, the requirement is how many cups bolded in blue, how many cups. So the answer should be in units or cups, right? And another issue for the question, we need to use the formula method. The formula, which is the CM method. The units sales or the units to attain a target profit in this case is equal to what? The target profit plus the fixed expenses divided by the contribution margin per unit. Contribution margin per unit or the unit contribution margin. The target profit in this case would be $2,500 plus the fixed expenses are $1,300 divided by the contribution margin, which is the difference between the price 1.49 minus the variable cost, which is 0.36. So the 2,500 plus 1,300 is equal to 3,800 divided by the contribution margin is calculated to be $1.13. So the answer will be 3,363 cups or units. Look at the solution here. The formula, units sales to attain the target profit, and remember that we are calculating in units or cups, are equal to target profit plus the fixed expenses, all divided by the unit contribution margin. Target profit is 2,500 plus fixed expenses are 1,300, all divided by the contribution margin, which is the difference between the price 1.49 minus the variable cost, which is 0.36. 3,800 divided by $1.13, and the answer would be 3,363 cups or units, and the answer is A. Okay. Quiz 5. The same company and same information using the formula method to determine the sales dollars. To determine the sales dollars. We need now to calculate the sales dollars. Now, the formula in this case, the dollar sign or the sales dollars to attain target profit is equal to what? Target profit plus fixed expenses divided by the CM ratio. CM ratio. Remember that if we divide by the CM ratio, the answer would be in a dollar sign. So the target profit is 2,500 or 2,500 plus 1,300, all divided by the ratio. The ratio is calculated from what? The contribution margin divided by the price. So 1.49 minus 0.36, all divided by 1.49. And this will give you the contribution margin ratio. So the answer will be 3,800 divided by 0.758, and the answer would be $5,013. Look at the answer. Sales dollar sign, sales dollars, or the total of sales to attain the target profit is equal to target profit plus fixed expenses, all divided by the CM ratio. 2,500 plus 1,300, all divided by the ratio. The ratio is calculated from price 1.49 minus variable 0.36, all divided by the price again, 1.49. So the ratio will be 0.758, and the total or the answer for the sales amount will be $5,013, which is B, number B. That's all for the target profit, or calculating how many units to attain that target profit, or what is the sales amount to attain that target profit. Landing objective number 7. Compute the margin of safety and explain its significance. Margin of safety. The margin of safety is the excess of budgeted or actual sales dollars over the break-even volume of sales dollars. It is the amount by which sales can drop before losses are incurred. The higher the margin of safety, the lower the risk of not breaking even and incurring a loss. The risk of not breaking even, which means I'm incurring a loss. If you imagine the graph, we do have a break-even point, which is the conjunction between the total costs and total revenues. So we are break-even. Break-even means we do have a profit of 0. Now, if I sell more than the break-even, the difference between that much of sales, which is the actual sales or planned sales, and the break-even sales is called the margin of safety. This means that the margin of safety can also be calculated from in dollar sign, which is sales, or the units, which is the difference between the units actually sold and the units to break even. If you imagine the graph. Again, the margin of safety is the excess of budgeted or actual sales dollars over the break-even volume of sales dollars. So I'm talking about the y-axis. Which represents the sales. The difference between actual sales and the break-even sales are called, or is called, the margin of safety. If we're talking about x-axis, then the difference between the units sold beyond or after the break-even and the units representing the break-even. So the margin of safety in dollars here is equal to total sales minus the break-even sales. Total sales minus break-even sales. If we're saying or asking about the margin of safety in units, then total units sold minus the break-even units. Let's look at the RBC example and determine the margin of safety. If we assume that RBC, the company, has an actual sales of $250,000. This represents the actual sales, okay? Given that we have already determined the break-even sales to be $200,000. If you remember this example, we calculate the break-even for this company to be $200,000 in sales volume or sales amount. If we actually sell $250,000, then the difference is called the margin of safety. The difference between actual sales and the sales of the break-even. Then the margin of safety is equal to 50,000, which is the difference between the 250,000 actual sales and the break-even sales of 200,000. Look at the two income statements. The first one in the middle represent the break-even income statement, and the one in the right represent the actual income statement if we sell 500 units. So the difference between the total sales between actual sales and break-even sales is called the margin of safety. For our example, it will be $50,000, $50,000. Now, if we're thinking about the units for the margin of safety, then the difference between the 500 and the 400 will be the margin of safety represented by units. The company's margin of safety can be expressed as a percentage also. As a percentage, the margin of safety as a percentage is equal to what? Margin of safety divided by the actual sales, which is the difference in this case. Okay, margin of safety is $50,000. The actual sales were $250,000. So the margin of safety as a percentage will be 20%. 20%. So 50,000, which is the margin of safety, divided by the base, which is the actual sales in this case, and the answer will be 20%. 20% as margin of safety percentage. As I said, the margin of safety can be expressed also in units. The margin of safety can be expressed in terms of the number of units sold. The margin of safety at the company is 50,000, and each bike sells for $500. So the margin of safety in units is 50,000 divided by the price, which is 500, and the answer will be 100 bikes. 100 bikes. If you go back to the example, the 500 actual sales units given, the 400 is calculated, then we can say the 100 is the margin of safety in units. If we have it as a margin of safety in dollars, fine, divided by the price, this will give me the margin of safety in units. So margin of safety in units, for this case, it will be 50,000 margin of safety divided by the price, and this will equals to 100 bikes. 100 bikes. Quiz number 6, coffee clutch is the average selling price of cup is 1.49, average variable expense is 0.36, average fixed expenses per month is 1,300, average of 2,100 cups are sold each month. What is the margin of safety expressed in cups? What is the margin of safety expressed in cups? Now, the question is talking about margin of safety in units. So I need to look at the x-axis, and compare between what? Between what is actually, or how many units sold actually, and the units of the break-even. Units of break-even, right? The cups sold actually are 2,100, which is the total sales in units. We need the break-even sales in units. Break-even sales in units. If you remember, we calculate this number previously in a previous quiz, and it was 1,150 units. So the difference between the total sales, 2,100, and the break-even sales, which is calculated previously, 1,150 cups, will be the margin of safety of 950 cups. So the margin of safety in units is equal to 950 cups, which is the difference in the x-axis between the actual sales in units to be 2,100 and the break-even in units, which is 1,150. For your if you go back to the quiz, just to remind you about how to calculate the break-even point in units. Break-even point in units was what? Calculated to be fixed expenses divided by the contribution margin. So fixed expenses here is 1300 or 1300 divided by 1.49 minus 0.36, 1300 divided by 1.13. Again, just to remind you how we calculate the break-even sales in units, it was fixed expenses 1,300 divided by the contribution margin per 1 unit. Okay, the contribution margin is calculated from price 1.49 and the variable cost 0.36. So the answer will be 1,150 cups. Now, the difference between the actual sales and the sales of the break-even will equals to the margin of safety in units. So the answer is B, 950 cups. Cost structure and the profit stability. Cost structure refers to the relative proportion of the fixed and variable costs in an organization. Managers often have some latitude in determining their organization cost structure. If we have this situation, the cost structure and the profitable stability, if we have high and low fixed cost structures, there are advantages and disadvantages to high fixed costs or low variable cost, and the other situation, low fixed cost or high variable cost structures. An advantage of the high fixed cost structure is that income will be higher in good years compared to companies with lower proportion of the fixed costs. A disadvantage of the high fixed cost structure is that income will be lower in bad years compared to companies with lower proportion of the fixed costs. Companies with low fixed cost structures enjoy greater stability in income across good and bad years because of the fixed cost or low fixed cost. Not so important. Learning objective number 8. Compute the degree of operating leverage. Degree of operating leverage at a particular level of sales and explain how it can be used to predict changes in net operating income. Now we will explain something called leverage or operating leverage. The operating leverage is a measure of how sensitive net operating income to the percentage changes in sales. If we change the sales for that much, so what will be the effect in the net operating income directly? And we are talking about managerial decisions. If we suppose that we will increase our sales for that much, is it worthy? And what will be the effect for the net operating income? It is a measure at any given level of sales of how a percentage change in sales volume will affect profits. Okay. The degree of operating leverage is calculating by the contribution margin divided by the net operating income. Simply, contribution margin divided by the net operating income. This will give me a degree of operating leverage. Let's use an example. To illustrate, let's revisit the contribution income statement for our company RBC. Suppose that we have this income statement depending on 500 bikes, so the sales is 250,000, variable expenses is 150,000, contribution margin is 100,000, fixed expenses are given to be 80,000, so the net operating income will be 20,000. Now, the degree of the operating leverage is calculated by contribution margin divided by net income or net operating income. So the 100,000 divided by 20,000. Remember that if we say contribution margin divided by sales, we are giving the contribution margin ratio. If we say contribution margin divided by sales, this is the answer of contribution margin ratio. Now, if we say contribution margin divided by net income or net operating income, this will give you a degree of the operating leverage, which is, again, what is the sensitivity of the net operating income for the percentage change in the sales, okay? Now the answer is $500,000 divided by $20,000, and the answer is 5. The meaning of 5, meaning of the 5. With an operating leverage of 5, if, by the way, the 5 means 5 times. Here, the sign is times. With an operating leverage of 5, this means if the company increases its sales by 10%, the net operating income will increase by 50%, which is the 5 times the 10%. If we increase the sales by 20%, which means the net operating income will increase 100%. Again, 20% times 5. The percentage increase in sales, in our example, 10%, multiplied by the degree of operating leverage, 5, and this equals to the percentage increase in profits for 50%. 50%. Let's prepare the two income statements for this change. The proof of changes. Suppose that we have already the 500 bikes statement, so we have a net income for 20,000. Now, I need to prepare another income statement if we increase the sales by 10%, okay? The 10% referring to the original income statement means that we need to sell 550, okay? Why? Because we are adding 10% for the original units sold, which is 500, then we need to have another 50 to be sold. So the new income statement refers to 550 bikes, okay? 550 bikes. 550 bikes multiplied by the price, in this case, it is equal to $500, and this equals to total sales of $275,000. Again, the 550 units multiplied by the price, which is $500, this equals to $275,000 The sales for a level of 550 units sold. The total variable costs for this level, remember that we do have $300 variable cost per 1 unit. Okay, $300 variable cost per 1 unit times 550. This equals to $165,000. Again, 550 units times $300 variable cost. This will equals to $165,000. The contribution margin for the new level will equals to the sales minus the total variable costs, which is 275,000 minus 165,000, and this equals to 110,000 or 110,000 minus the total fixed costs, which is given for the question for 80,000, and the net operating income will be the contribution margin 110,000 minus the fixed expenses, which is 80,000, and the answer will be 30,000. So we will recognize 30,000 or get $30,000 in the net operating income if we sell 550 units, which is an increase of 10% in sales. If you like, the 10% is also represent the difference between 250,000 and 275,000. So the 250,000 multiplied by 10%, this equals to 25,000 plus the base, which is 250,000. This equals to 275,000. Okay. Now look at the increase in the sales, which is 10%, and the increase in the net income, which is the comparison between the 20,000 and the 30,000. We do have an increase in the net income by 50%. The 20,000 becomes 30,000, which includes an increase for 50% of the 20,000, which is 10,000. So 10,000 plus the 20,000, this equals to 30,000. 10% increase in the sales from 250 to 275,000. This results in a 50% increase in the income from 20,000 to 30,000. Okay, and this is the meaning of the leverage. If we increase again, if we increase the sales by 10% times 5 leverage or operating leverage as calculated, this will result in 50% change or increase in the net income or net operating income. Okay. So we can use this percentage to predict for our future. Suppose that we need to add or increase our sales by X percentage, what would be the effect for the net income? Quiz number 7. Coffee clutch is an espresso stand in a downtown of coffee is $1.49. And the average variable expense per 1 cup is $0.36. The average fixed expenses per month is 1,300, and average of 2,100 cups are sold each month. What is the operating leverage? What is the operating leverage? Let's open a new slide to add the solution. Okay. We need to prepare an income statement. Why? Because we need the equation includes what? Includes the contribution margin, just to remind you how to calculate the operating leverage. It is simply the contribution margin in total divided by net operating income. Okay, so we need the number of the contribution margin and the number of the net operating income. Regarding our example or quiz, we do have the numbers or per 1 unit, the price, the variable cost, and how many units do we sell. So we need to prepare an income statement in order to have, or in order to calculate the operating leverage. Let's start by doing the following. We do have 2,100 cups sold, right? Which is actual sales. 2,100 cups. So the sales in this case is equal to what? Remember that we do have 500 as a price per 1 unit. No, sorry, I'm talking about a new company. So the price will be 1.49. 1.49, is it? 1.49 times 2,100. This equals to what? Let's calculate it. 2,100 times 1.49. This equals to 3,129. $3,129 for the sales, right? Minus the total variable cost, which is 0.36 times 2,100, is it? This equals to what? 0.36 times 2,100, 756. The difference between these two is equal to total contribution margin. Total contribution margin, and the difference will be 2,000 minus total fixed costs, and this is given for 1,300 for this company, and the net operating income will be what? 1,073. Okay, 1,073. Now, the operating leverage. The operating leverage is equal to what? Is equal to okay, the contribution margin divided by the net operating income, which is 2,373 divided by 1,073. 73. This will equals to 2.21 times 2.21 times. Look at the solution here. So the sales 3129 minus variable cost 756. Contribution margin is 2373 minus 5 fixed cost 1300, and net operating income in this case $1,073. Now the operating leverage is equal to the contribution margin 2373 divided by net operating income 1073. This equals to 2.21. 2.21, and the answer is A, 2.21. The next and the last quiz for this topic. At Coffee Clash, the average selling price of a cup of coffee is 1.49. Average variable expense per cup is 0.36. Average fixed cost is 1,300, and average of 2,100 cups are sold each month. If sales increase by 20%, by how much should net operating income increase? The question is, if the sales increase by 20%, by how much should the net operating income increase? This is simply can be calculated from the percentage increase in the sales, multiplied by the operating leverage, which is calculated in the previous quiz, 2.21. So the answer will be 44.2%. Look at the answer. The percentage increase in the sales, 20%, multiplied by the degree of the operating leverage, 2.21, and the percentage increase in the profit should be 44.2%. So the answer is D. Verify. What do we have here? Depending on the statement that we prepare in quiz number 1. Okay, so we do have 1,003 income. Depending on this as a base, verify that we have an increase in the income for that much, which is 44.2. Look, the actual sales 2,100 cups, and we need to increase our sales by 20%. So 20% in addition to the 2,100 times 1.2, if you like, will equals to 420 plus 2,100. This equals to 2,520. Again, we have 2,100 cups multiplied by 20%. This equals to 420 cups. So the new volume or new units to be sold will be 2,520, which is 2,100 plus 420. So 2,520 cups multiplied by 1.49, this equals to 3,754.8 and rounded to be 3,755. The variable cost 2,520 times 0.36. This equals to 907.2, rounded to be $907. The contribution margin for the new situation will be 2,849, which is the difference between these two numbers, 3,755 minus 907. $2,848 minus, we don't have any change for the fixed expenses, so 1,300, and the answer will be 1,548. Now, I need to calculate the change in the net operating income. 1,548 minus 1,073, all divided by 1,073. And the answer is 44, or if you like, 0.44 268, okay? 44.2 or 3 rounded will be the same. Change in the sales for 20% results in change in the net operating income by 44.2%. And this is the proof. Let's stop here. This is a quick information about the structure again. Structuring sales commissions. Companies generally compensate salespeople by paying them either a commission based on sales or a salary plus a sales commission. Comparison based on sales dollars can lead to lower profits in a company. Let's have an example. Structuring sales commission. A company produces 2 types of surfboards, the XR7 and the Turbo. The XR7 sells for $100 and generates a contribution margin per unit of $25. The Turbo sells for $150 and earn a contribution margin per 1 unit of $18. The sales force at the company is compensated based on sales commissions. So the solution, if you were on the sales force at the company, you would push hard to sell the Turbo, even though the XR7 earns a higher contribution margin per unit. To eliminate this type of conflict, commissions can be based on contribution margin rather than the selling price alone. I will postpone this topic to be explained in another chapter, actually. We will look at this topic in another chapter, 13 and 14. I will stop at the beginning of learning objective number 9. Thank you and have a good day. Thank you.